So higher interest rates abound. How does that affect everyday life? Plus, on the program, we're also going to talk about some of the things that you can do to perhaps improve your financial picture. So welcome on into Dollars and Cents, where we help you make sense out of all of life's decisions. We're Central Florida's longest running radio program, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on any of those platforms like Spotify or YouTube or iTunes or Amazon. Find our channel and then hit subscribe. That way you can know exactly when we upload new content. So make sure you check us out there. Any problems finding us? Well, go to our website, nelsonfinancialplanning.com, and you'll see the icons in the upper right-hand corner, and then that will allow you to get directly connected. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So 2 days from today, April 18th, is the official tax deadline, some obscure holiday in Washington, D.C., or maybe it's Massachusetts, that causes the tax deadline to kick one more day past the usual deadline. Of course, the 15th fell on Saturday, so you can't have that be the deadline. Hence, this year it is on the 18th. Another season obviously drawing to a close. For some commentary on some of the trends that we saw this season, make sure you go to our website at nelsonfinancialplanning.com. Check out our blog post where we talk about some of these current trends that we've seen sort of develop during the course of the year. Also, a couple weeks ago, we spent some time on this program talking a little bit about that as well. Now, here's the key piece. Great. Your taxes are done. Season's behind you. All that good stuff. Don't just take the envelope and throw it into a file cabinet. Your taxes are actually a very good starting point to get a better understanding of what your financial picture looks like. When we talk about trying to get a better handle on your financial picture, we often talk about it in terms of sort of two parts, and those two parts are very standard items when you think about a business, and that is an income statement and a balance sheet. And the reason that we like to use sort of those traditional corporate terms and apply them to the individual is, well, because they show good information, right? So if you think about an income statement as a business, it's money in, money out. Income that you're bringing in, and then expenses, money that is going out. The difference, hopefully, means that at the end of the day, if income is more than expenses, then you've got a profit. Good for a business, also good for you, because then you can take that profit, fund retirement, increase your emergency savings, pay off other debt. You get the picture. So the tax return is a pretty good synopsis of the income part, right? I mean, that's certainly what you're reporting on your tax return. It is an income tax return. So get a pretty good handle on what your income is, and then also shows some of the expenses, potentially, if you're itemizing. But it certainly captures that first part that ultimately allows you to get a better understanding of where things stand. So a great starting point, if you will, to helping figure out what the landscape is for you personally from a financial perspective. Another item that you want to observe on your tax return, rather than just chucking it into a file cabinet, is if you owe or if you're getting a refund, there are things you should probably think about doing. So we'll start with the refund first. So you got a refund, you're excited. Wow, that's great. I got money back. Well, you do know that that is your own money, right? I mean, that's not like a gift from heaven above, courtesy of the folks in Washington. It is, in fact, your money that you're getting back. So if the refund was a few $100s, fine. No reason to get excited about that one way or the other, because who knows, that could easily swing the next year to you owing a few $100s. But if the refund was several thousand, I think that's where you want to start to have a conversation with yourself about, well, wait a minute. If I just got a $5,000 refund, that's really kind of the equivalent of an extra $400 a month that I could have in my checking account that pretty sure you can do a better job deciding about how to use that money than the friends in Washington, right? And so why not you get that money along the way rather than send it all to Washington and then Washington just sends it back? Because remember, they don't pay interest when they do that. So that's a scenario of a refund. What if you owe? Well, speaking of the word interest, they do charge interest if you owe. Now, this is a relatively newer concept. Well, that's probably not the right description. It's a concept that's been around forever. If you don't pay your taxes in along the way, it's sort of a pay-as-you-go system here in America. So if you don't pay your taxes along the way, then the IRS says, well, that's fine, but we're going to charge you a little bit of interest for not doing that. Well, over the past, decade or so, the interest rates have basically been zero. So no one's really paid a whole lot of attention to that one way or the other. But guess what happened? The interest rates have gone up, which means that you now are going to have to start paying some money. And in fact, for this year, 2023, that interest rate comes in at 7%. That's a little steep. And certainly that should move you or motivate you to say, wait a minute, I owed money. I want to avoid the extra 7% cost, so I need to take a deeper look at where I am withholding money. So the kinds of things that you need to look at there are, okay, if I'm still working, what's my W-2 withholding look like? If I'm owing a bunch of money, then it's important to look at your W-2 and really look at the ratio of taxes withheld to total income. Calculate out that ratio. You can also do the same thing on your tax return. A lot of tax software actually will tell you what that average tax return is. If you have trouble finding it, well, there's a line that says total tax, and then there's another line that says total income. Take the total tax, divide it into the total income, and you get the idea. That's the percentage of dollars that you should generally be withholding on every piece of income that you're getting. So do that analysis on your W-2s, taxes withheld versus the amount of income, and then you'll find the number. If it's above what that number is for your whole return, well then great, that one's in good shape. But if it's below or below by a lot, that's where you need to go back around and improve or increase the tax withholding that's happening on your W-2. The other thing that you need to be aware of is some key sort of circumstances that as they happen, they will produce also some tax issues. Chief among them is when you start to collect Social Security. Surprise, surprise, depending upon your income, and most Americans are finding this to be true these days because the income threshold hasn't changed in 40 years and was never indexed to inflation. Social Security is going to be taxable. So if you start Social Security, then you probably need to also do some tax withholding on that. Similarly, if you change jobs, this is one of those traps that people can fall into. If you change jobs, each job is withholding tax based upon that being your job. A lot of that is oblivious, if you will, to what other job you may have had. So you could find that your tax withholding, particularly in those years when you're changing jobs, is quite low. We're going to take a break and continue this conversation on some of the other things to be aware of, particularly when it comes to the fact that there's a higher interest cost when you owe money to the government. Started a little bit last year, but it's certainly present for this year, 2023. So stay tuned for that here on Dollars and Cents with Joel Garris. Talking about the end of tax season and some of the things that you should be doing rather than just taking the tax return and throwing it in your file cabinet, particularly if you owe money. There is an interest cost associated with that is particularly high these days as a result of the rise in interest rates, thanks to the good folks at the Federal Reserve. And so for the year 2023, that interest rate is actually going to be around 7%. So if you owed money on your taxes, then you certainly want to take a deeper look at how and how much you're having withheld on your various sources of income. Before the break, we were talking about some of the easier ones, right? If you got a W-2, look at the ratio. How much taxes are getting withheld versus the total amount of income. But then we were talking about some of the different things that can happen along the way that you need to be really aware of can create some tax issues, particularly on the withholding side of the equation. So chief among them, if you're changing jobs, the one job doesn't sort of know about the other. So sometimes the tax withholding, particularly sort of on that second job, can be lower or lighter. And so consequently, you find that you owe money. If you start collecting Social Security, that's another one where most folks don't think it's taxable. The reality is, for the vast majority of Americans, it certainly is. So you want to make sure that you're doing tax withholding on Social Security. Lastly, another situation that sort of comes to mind is if it's the year in which you have to take your required minimum distributions, or for that matter, the year in which you retire. Remember, if you're retiring, then you don't have an employer who's sort of taking care of the tax withholding on your behalf. When you're retired, you have to do that on your behalf. So you have to make sure that you know where you're coming in at to make sure that you are withholding enough, particularly if you're taking income out of a retirement account, or if you have triggered your required minimum distribution, then you also need to make sure that you are withholding on your taxes. So those are just some of the things to be thinking about, particularly if you owed on your taxes, or if you have any of those kinds of life changes. You started to collect Social Security, you retired, you changed jobs, you started your required minimum distribution. All of those will trigger the need to review, okay, well, what's the tax liability on this going to be? Particularly, as we've said on the program, the interest cost is 7% if you don't pay enough along the way. So certainly something to be aware of. Welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, particularly, I guess, on the tax side of things. Only appropriately enough would be sort of a bit of a focus on this week's program. You still have 2 days left if you haven't quite gotten things together, but the clock is ticking. Yes, you can file an extension, but remember, when you file an extension, you have to make sure that you've paid in a sufficient amount to cover any tax liability. Otherwise, not only do you get hit with interest, but you start to get hit with penalties, and that can really add up in a very, very short period of time. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a great team of folks, all of whom happen to be certified financial fiduciaries as well. And they stand ready to help you improve your life with a successful and cost-effective financial plan this very week. So give them a call at the office, 407-629-6477, or visit our website, Nelson Financial Planning, for more information. So speaking of owing on your taxes, about 1 in 4 Americans, according to the latest IRS data, actually do owe on their taxes. Average balance due is not a small amount. The average balance due for those 1 in 4 that owe on their taxes is about $8,000. So that's quite a little bit of money that quickly adds up. So some of the things you need to also be thinking about if you are owing money is to be thinking about some quarterly payments along the way. And those quarterly payments allow you to pay into the IRS an estimate in terms of what your tax liability is going to be. First one's due April 18th, so that's kind of the kicker of, okay, great, I owe taxes for last year, and then I'm going to pay some for taxes for the current year. That is unfortunately how kind of the quarterly payments work out for the current year. Then you've got another one in June, another one in September, and another one in January. So that's one of the ways in which to kind of get in front of the tax obligation, because the reality is that if you owe money and you don't have any money to pay, it can get costly pretty quick. We mentioned the 7% interest rate, but then there's a failure to pay of 3% as well. So all in all, that can add up pretty quick to about 10%. So certainly you want to file a return. If you owe money, don't just ignore and don't bother to file the return. You want to file that return, and at the very least, you want to engage in the conversation with the IRS about doing some kind of a payment plan in order to make sure that that tax liability is solved. The reality, of course, is that yes, that tax, those payment plans with the IRS, they do charge interest, and as we've said, that interest is somewhat high. So anyway, that's kind of the recap, if you will, on the tax side of things. Two other stories that we wanted to get to on the program this week from this past week's headlines. First is sort of the economic data. On Thursday, the producer price index fell by 0.5% for the month of March. The expectation was actually it was going to be flat. So a decrease means that, in theory, inflation, maybe some of the economic data showing that it's starting to come down. That Thursday data was actually followed on the heels of the Wednesday data about the CPI, the Consumer Price Index data, that also showed that inflation was easing a little bit. Only a rise of 0.1% for March. Year over year, putting inflation at about 5%. So that sort of has fanned some continued hope that the Federal Reserve may finally be done raising rates, or at the very least, maybe only one more here in May at a quarter point. Markets, of course, like that shift, right? We've been talking about this for many months here on the program. Lower interest rates, or Fed not raising interest rates quite as fast as what it has done, certainly allows folks to get a little bit more comfort, and obviously the market like that, staging particularly strong upward movement this past Thursday as well. So that's story number one from the past week. Story number two is about Social Security, now projected to run out 1 year earlier than previously projected in the year 2034. Now, a few caveats. Number one, it's not really running out of money. Running out infers that something is going to zero. At least in my book, it does. What it really means is that they'll only have enough resources to pay about 80% of the promised benefits. The other caveat in all of that is that Congress does nothing. Congress doesn't take any action. We stay on the path exactly as things are, and this is what's going to happen in the year 2034. The reality is Congress will take some action. It's just a question of when that political willpower actually comes to the forefront. For perspective, this is only the third year in a row where Social Security is actually paying out more than it's getting in on an annual calendar year basis. If we think back to the late 70s, early 80s, that actually happened 7 straight years before you wound up having the political willpower to actually do something to adjust things like raising age to 67 and the like. Hopefully they won't wait another 4 years to deal with this, but who knows? But just a little perspective on that. Certainly on a future show, we're going to be joined by our fellow certified financial fiduciary who also happens to be a National Social Security advisor, Rob Field, to talk much more about this at length. But we wanted to certainly get that particular headline out to you all because it made some news this past week. That is for sure. So anyway, speaking of interest rates, there's been 9 straight interest rates, right? And so the question is, well, at some point, that's going to have an impact. So we're going to talk about some of the ways in which these higher interest rates are starting to impact you in terms of your money. So whether that be car loans or credit card rates or mortgage rates, certainly there's starting to be a relatively significant impact on what those rates look like and the impact that they have on the average consumer. So in our next segment, we're going to be talking a little bit about how those rates or the increase in rates affect everyday life. So we're going to shift some gears during the course of the break and change topic. So during the break, keep on listening to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. Coming to you here on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast or social media channel. Go to our website, Nelson Financial Planning. Click on any of those icons and you'll get immediately connected. We'll be back after these messages. Over the past 12 months, 9 straight rate hikes, right? Only about half of them are in the economic soup at this point, even because interest rates hikes typically take 6 to 9 months to sort of make their way into the economic system. So be curious to see how the rest of this year plays out as all of those interest rate hikes that happened in the back half of last year start to come on board. However, if you've bought a house lately or shopped for a car or had a credit card bill, you know that those rates actually came into the economic system pretty quick when it comes to what the interest is that you are paying on that. So we thought it would be important to sort of talk about what the implications are and what the impact that these higher rates have so that you can make better decisions along the way. That, after all, is the premise of the program, right? Aptly entitled Dollars and Cents. We help you make sense out of all of life's financial decisions involving your dollars. We're one of Central Florida's longest running radio programs, also one of the top 25 financial planning podcasts on the World Wide Web. So check us out there on your favorite platform of choice. Go to our website if you have any trouble finding us, nelsonfinancialplanning.com. My name is Joel Garris. I'm a certified financial planner and a certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So jumping rates ultimately are going to have an impact on the economy, but more importantly, they are hitting your wallet very quickly these days. Credit cards in particular is where the credit card companies don't really wait a long time before they change those rates to reflect the current interest rate environment. And the jump in interest rates can certainly have some major implications on the costs associated with credit cards because the federal funds rate, that overnight rate that the Federal Reserve sets, ultimately impacts the prime rate, which credit card companies use to ultimately determine the APR, the annual percentage rate on that credit card. And certainly a tremendous amount of credit card debt outstanding, almost $1 trillion at year-end 2022. So that's a lot of money that now is at a much higher interest rate. To put it into perspective, credit card accounts carrying balances averaged an APR of about 20.4% in the fourth quarter of last year, up from just the year prior, an average of 16.4%. Folks, that's a 25% increase in the interest cost on your credit card. So that's one of the biggest reasons why we always talk about on this program, hey, you really need to make sure that you're keeping those credit cards all paid off. Build the emergency savings fund. That's always step one. And then step two is some of this really high interest rate debt really requires you to sort of have that be your next step to sort of tackle on things. If you're looking at a home, certainly those numbers have changed as well. Similar impact there. What was 4% or under 4% on 30-year fixed rate mortgages now gone up to about 7%. Not quite that high right now, but if we simply look at the example of a 30-year mortgage of $100,000, although I probably can't buy a house for $100,000 anywhere in America today, but it's an easy math example. So on $100,000 of mortgage, when interest rates are 4%, you're going to pay about $477 per month of principal and interest. When mortgage rates are 7%, that same number goes to $665 per month on that same $100,000 mortgage. That, folks, is a 40% increase. So a pretty significant increase in that monthly payment on your mortgage. And I guess what's surprising is still not quite into the pricing of housing. And that could be that Florida is relatively unique in that there's a lot of people coming into the state. And so there's still that ongoing demand. And so the impact of those higher interest rates really aren't quite showing just yet. But remember, there's always that lag effect when it comes to interest rates and how those ultimately play out. Similarly, on car loans, right? New cars, the interest rate over the course of the past year has gone from like 6% all the way up to 9%. So when you look at the average payment for a new car, it's now over $700 per month. So maybe look at making that existing car last longer, because that's certainly a pretty significant payment when it comes to monthly payments on a car. So if that doesn't show you sort of where the real impact of those higher interest rates is hitting, you can certainly see that. Credit cards, housing, cars, and certainly underscores the need to make sure that you are really paying attention and not running up credit card debt. The average rate on that now over 20%. That's just a really high number to get out from under. Once you start having credit card debt, it really starts to snowball pretty dramatically in terms of not being able to get on top of that. So really got to watch that. The only silver lining, if you will, on all of these higher interest rates is what you are seeing on your savings account. But beware, because a lot of those savings account rates haven't moved in lockstep to the increase in interest rates. A lot of banks have been very slow to raise their interest rates on savings or savings accounts and the like. So make sure you're really taking a moment to sort of shop around on, can I get a better rate with the banking institution that I'm using? If I move money over to a savings account or a money market account, is there a better option where I can make a little bit more interest along the way? I think you may be surprised at how easy it was. We just engaged in this exercise a little bit ago here at Nelson Financial Planning, and then all of a sudden it's like, yeah, we can do that, and you can have a savings account for some of the extra cash that's sitting in these business accounts and lo and behold make 4%. And I'm like, why did we have to ask? But you have to ask, because they're not going to be all that willing to share that with you. So make sure you're asking those questions. If there is a silver lining on all of these higher interest rates and those kinds of things, it really is that you've got the opportunity to make a little bit more on your savings account. So make sure you're getting the best savings rates out there. Ask the questions as it relates to your banking institution so that you can get a little bit more money and at least take advantage of the silver lining that comes with higher interest rates, that ultimately the savings rates winds up being a little bit higher on that end. So just certainly some things to be thinking about of what the impact is on higher interest rates. A lot of negative in terms of higher interest rates, particularly if you're in the home purchasing market or the car buying market, or if you've got any credit card debt. But make sure you're also taking care of that sort of silver lining, if you will, in terms of interest rates on savings accounts. With that, we'll take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So what are some of the things that you can do to help improve your overall financial picture? We mentioned one earlier in the program when it came to your tax return, right? Don't just take the tax return and throw it into the file cabinet and not look at it. Use that as a starting point to get a better handle on exactly what your income looks like. Because after all, that's pretty much a summary of your income, right? It's called an income tax return for a reason. And certainly that tax return is a great way to start that analysis. Because one of the ways that's so crucial, or one of the things you can do to help improve your overall financial picture, is to understand your overall financial picture. So that starts with understanding what your income is. There you go. There's the tax return coming back around. And then taking a look at what your expenses are. If you think of it like a business, if your expenses exceed your income, well, then you have a problem. You're not going to be in business much longer. Similarly, on an individual level, that may mean that you're proceeding to rack up credit card debt, not building up an emergency savings account. As we were talking about in the last segment, those credit card rates up 25% just in the past 12 months. Average credit card rate, interest rate in America over 20% these days. So important. The process of improving your financial health starts with getting a checkup, seeing where you're at. And then, much like when you go get your annual physical, and you should be going and getting your annual physical, then you take all the blood work, get all the things checked out, and okay, here's where you're doing good, here's where you're doing bad, here's the thing that things that you need to change. I need to start taking a vitamin D pill, but anyway, I digress. Okay, because that was low on my blood work. Anyway, it's important to get that status quo of where you are. Income, expenses, that's your income statement. The other side is the balance sheet. So the balance sheet takes a look at what you own and then what you owe. Hopefully what you owe is less than what you own. Otherwise, you're in the negative on that one as well. You don't have any equity, if you will, anywhere to be able to utilize that if you needed that. So those are really sort of the two ways to be thinking about in terms of getting a better financial picture. But there's a lot more things that you can do that we're going to share with you here in this segment. But we want to take a moment and welcome folks on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest-running radio programs, also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you check us out on those platforms and subscribe to us. That way you'll know when we upload new content. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary at Nelson Financial Planning. So to improve your financial picture, it starts with understanding your financial picture, right? Getting a handle on the income, getting a handle on the expenses, using the tax return as a pretty good summary for what the income actually is, using your bank statements, your debit card receipts, your credit card receipts often provide a very good resource for getting a handle on what your expenses are. Because the reality is, these days, most people don't use cash. They're using credit cards, they're using cash apps, or they're using their debit card, which obviously then maintains a digital footprint and electronic record of how you're spending money. So make sure you take a look at that and then take a look at what you own versus what you owe. Now, the other thing to be thinking about is there's no way you're all of a sudden going to wake up one month and be like, okay, now I can save an extra 20% of my income, and now I can ultimately create that emergency savings account that I have long been trying to do. No, it's unlikely that that is going to happen. The reality is that change is best done on an incremental basis. So when we're thinking about putting money away or putting money into that employer retirement plan, think about maybe increasing the contribution rate by 1%, right? Do that every year, and ultimately you'll be at a pretty good threshold in a few years. So the reality is that you're not going to be able to make those big changes. I think this is where people kind of get daunted and throw up their hands and say, forget it, I just can't do it. The reality is that you're not going to wake up next month and have a $10,000 emergency savings or have a bunch of money in your 401k. It starts small and it starts incrementally. The key piece to that is one of the things that we've always said, which is that you've got to get in the habit of paying yourself first. Way too many people pay themselves last, meaning they run through their month and they have their income come in and then they have the expenses go out, and then it's sort of, well, whatever's left over, I'll try and save that. No, the better way to do that is start with that savings first, paying yourself first. Very crucial, and one of those small incremental changes that you can make that ultimately puts you on a path to better success. And of course, it goes without saying, particularly with where credit card debt is, that's sort of the first thing to be looking at. Emergency savings and paying down those high interest rate credit card debts, because you don't want to get in the habit of using those credit cards as your emergency savings, right? I mean, it's just too easy to do that. But the reality is that when you do that, you're ultimately running the risk of falling behind even further, particularly when you consider how high those interest rates are, right? 20%, that's a pretty good chunk of money that is ultimately going to be eating away at whatever it is that you're trying to pay down, because the 20% kicker is a pretty significant amount of money. And then, of course, to be consistent, right? I mean, as with anything in life, it's so important that you are consistent. If you're trying to get healthier, right? It's not go out and run one time and then take a month off. That's not going to be how you wind up getting healthier. It's not eating a salad on a Monday and then, visiting McDonald's Tuesday through Friday. It's about building consistent behavior. And that certainly is true when it comes to investing, when it comes to your finances as well. So the importance of being consistent also relates to how you ultimately approach the investment side, right? Because in terms of investments, you want to be consistent on those. If you get too distracted by what's going on in the headlines, guess what? The headlines will be different tomorrow, and I'm pretty sure they'll be designed to scare the you-know-what out of you. So at the end of the day, you have to kind of put all of that to the side and ultimately focus on being consistent when it comes to your investments. And then, of course, make sure that you are fully diversified, right? And so it's not like you're owning just a small handful of things in one particular sector, but make sure you're broadly diversified. And I'll tell you, the current climate is a good reminder of why it's so important to have that broad diversification, because at the end of the day, there are certainly some asset classes, some types of companies that are doing better than others, particularly in the current economic climate. So certainly some things to be thinking about, particularly when it comes to your finances and how to improve that overall financial picture. I might add one last one in here, and that would be to make sure that you take the time to name beneficiaries on your various accounts and various assets. It's so important to have those beneficiaries named so that if anything does happen to you, things move relatively easily to go to whoever you've named as the beneficiary on your account. So those are just some of the things that you can do to make sure that you are working towards improving your overall financial picture. Well, that's about it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard and want to learn more about how our team of certified financial fiduciaries at Nelson Financial Planning can help you change your life with a successful and cost-effective financial plan, make sure you visit our website, nelsonfinancialplanning.com, or give the office a call this week at 407-629-6477. Have a great rest of the day.